Hey everyone, and welcome back to Gold Off the Charts. In this unpredictable, high-stakes financial world, we don't just watch the show, we look for the logic behind the scenes. A bit of deep financial insight every day will help you see further, walk steadier, and outlast the competition on your journey to building wealth. How's everyone's heart rate after the last 24 hours? We just witnessed a textbook bloodbath in the precious metals market, immediately followed by a massive counter-rally. Just when it looked like a total collapse, the market pulled off a classic V-shaped reversal. Let's look at gold first. The price took a massive tumble from its recent highs. It was like being in an elevator with a snapped cable, plummeting until it hit roughly $4,400. People, we're not talking about a small dip here. This was a 1,000-point earthquake in just a few days. However, by yesterday, gold managed to bounce from that 4,400 floor back up to 4,800. Seeing swings of several hundred points in a single day is becoming the new normal. Gold is currently looking even more volatile than crypto. If gold's move was a rebirth, then silver's recovery was a complete phoenix rising from the ashes. Silver's crash was brutal, bottoming out near $71 and wiping out countless over-leveraged long positions. But as of yesterday, the tide has turned. Silver has staged a powerful comeback and is now back above the $83 mark. I know many of you holding positions are feeling incredibly conflicted right now. It's almost like financial mood swings. One second you're panicking about a margin call, and the next you're watching your balance recover. Everyone is asking, is the crash over? Are we out of the woods yet? Is there still hope for that $6,000 gold target we've been dreaming of? Today, I'm going to pull back the curtain on this crash and bounce. We need to understand what this volatility actually means. More importantly, at this crossroads of buyers versus sellers, how do we spot the next move? First, let's be real. The risk hasn't disappeared. We shouldn't let a two-day bounce blind us into thinking the coast is completely clear. The precious metals market is still in a fragile state. Why? Because of the massive amount of unrealized profit sitting at the top of the market. To put it simply, the gold rally over the last 3 years has created about $20 trillion in paper profits for investors worldwide. That is a mind-boggling number. That $20 trillion isn't just a win, it's a sword of Damocles hanging over the market, ready to fall at any moment. Citibank's research team just dropped a heavy-hitting report on this. They warned that this mountain of wealth could trigger a reversal. Why? Because the market structure is currently lopsided. If just 5% of those paper profits, roughly $1 trillion, decides to hit the sell button to cash out, it would completely overwhelm the current global demand for physical gold. Let that sink in. This means if even a tiny fraction of investors want to turn their screen numbers into cold, hard cash, the physical market won't have enough buyers to absorb the sell-off. That would be a knockout blow for gold prices. Citi even shared a forecast that would give any bull a heart attack while they see 5,000 as possible in the next 3 months. They are very pessimistic about the second half of 2026. Their base case predicts gold falling back to $4,000 per ounce by 2027. They argue that this bull market isn't actually being driven by central banks, but by massive capital allocation from private investors. They estimate the capital inflow pushing gold up right now is around $1 trillion, while central bank demand has actually stayed flat for the last few years. It's hovering between $100 billion and $150 billion. In other words, it's the hot money from investors that pushed gold to these heights. However, the physical gold market is too small compared to total global wealth. It's like trying to pour the ocean into a small backyard pond. It just can't hold the volume. Citi did an interesting breakdown. The total value of the gold supply is only about 0.1% of global household wealth. This means if people want to move even a tiny bit of their money, say an extra 0.1% allocation into gold, global mine production would have to double just to keep up. If the average global allocation went from 4.1% to 5%, that tiny 0.9% increase would require 11 years of total mine output, or half of all the gold jewelry and bars ever made in human history. What does this tell us? The physical market simply can't handle a massive wealth migration. For supply and demand to balance out, the price has to skyrocket. This is the logic behind the recent surge. But the flip side is where it gets dangerous. This is the structural trap of the current market. The danger lies in a reversal. The massive profits accumulated over the years are like a dam holding back a lake. The higher the price goes, the more violent the flood if the dam breaks. The risk is that while $1 trillion in new money is driving the bus, there's $2 trillion in old money waiting to get off. Only 5% of those investors need to leave to crush physical demand. That's why I'm telling you, the risk is still on the table. But hold on a second. If you hear this and decide to dump all your gold and silver and run, you might regret it later. Because here is the other side of the story. While that risk exists, it isn't necessarily uncontrollable. Why? Because of the crash we just sat through. That epic drop was actually a way of venting that pressure. You could even call it a deliberate precision demining operation to clear out the risk. It looks like a coordinated move aimed at cleaning out overcrowded long positions. I'm not just spinning a yarn here. Look at the facts. The timing of the precious metals collapse lined up with other market events so perfectly that it's hard not to be skeptical. At the end of January 2026, silver crashed 35% from $120 to $78 in 24 hours, and gold dropped 12%, wiping out $3 trillion in market value. But here's the kicker. The crash happened right as the systems at the London Metal Exchange and HSBC went down. What are the odds of a glitch happening exactly at the peak of the panic? To make it even weirder, the CME suddenly hiked margin requirements, and this all happened right as Asian markets were closing for the weekend. While Asian investors were asleep or enjoying their weekend, the butcher's knife was already in the air. All signs point to a well-orchestrated market flush. The evidence? JPMorgan Chase managed to close their short positions right at the absolute bottom. They made a killing while retail traders were getting liquidated. The CME's margin hike forced a chain reaction of liquidations among leveraged traders. This triggered a stampede of selling algorithms. That's why the floor fell out so fast. To top it off, a false report from Reuters claimed the U.S. was ending support for strategic metals. It was officially debunked later, but at the time, it was the last straw that broke the camel's back. Sending everyone rushing for the exit. History doesn't repeat, but it definitely rhymes. We saw this same pattern in 1980, 2011, and December 2025. When silver flies too high, exchanges hike margins, forced liquidations kick in, and the price comes crashing down. This is the fourth time we've seen this play out, only this time, the swings are much bigger. We have to see the reality. The paper market and the physical market are two different worlds. Paper gold and silver are easily manipulated by margin changes and high-frequency algorithms, but physical gold, and especially physical silver, are facing massive structural shortages. We've seen a supply gap of roughly 200 million ounces a year for 5 years straight. Silver was trading at a $40 premium in Shanghai, proving that physical demand is still rock solid. A paper price crash doesn't fix a physical shortage. On the contrary, by flushing out the weak hands and leveraged gamblers, it lets the big players cover their shorts and gives long-term money a better entry point. The media blames macro news, like Fed nominations, but the real drivers were margin calls and market structure. Leveraged ETFs dropped 66% in this move, which is a loud warning about the dangers of using too much debt. So, how is this different from crashes in the past? That brings us to our third point. This time the foundation is solid enough that gold could still reach $6,000. We need to realize this isn't like the top of the market sell-offs we saw back in 2012 or 2018. Those old crashes were backed by trend reversals like the Fed aggressively hiking rates, a skyrocketing dollar, and crashing inflation. Today, the world is still stuck in weak growth and low rates. The trust issues with the US dollar haven't gone away. The core reasons why people buy gold are still very much in place. There's no sign that the big picture trend has flipped. Let's look at the Fed chair nomination drama. Is the market overreacting last Thursday? Word leaked from the White House that the Trump administration wants former Fed Governor Kevin Warsh for the top job. This sent shockwaves through the market because everyone was expecting BlackRock's Rick Rieder Reader is a dove pro-low rates, while Warsh is seen as a hawk pro-high rates, with the world economy in chaos. With U.S. debt over $38 trillion, Europe in recession, and currencies swinging wildly, the market saw Warsh as a tough love candidate who might stabilize things. Based on that, the U.S. dollar index, DXY, shot up, and the gold-silver rally hit a brick wall. This triggered a take profit and run mentality, causing Friday's sharp pullback. But we need to look closer at who Warsh actually is. If you look at his history, his stance has actually shifted over time. When he was on the Fed board from 2006 to 2011, he was a classic hawk, voting to raise rates and opposing money printing. But after he left in 2011, especially during Trump's first term, Warsh started supporting rate cuts to fuel growth, lining up with Trump's own views. However, out of the four candidates Trump considered, Warsh is the only one who openly hates the Fed's massive balance sheet. He famously said in 2023 that the Fed's massive holdings are distorting markets and hiding long-term risks. Deutsche Bank's chief economist already called this back in December. He believes Warsh will likely support lower interest rates to help Trump's stimulus plan, but he'll try to offset inflation by shrinking the Fed's balance sheet. But this cut rates while shrinking the balance sheet plan only works if banks don't need as many reserves. Right now, U.S. banks are more dependent on those reserves than ever, and changing the rules isn't going to happen overnight. So even if Warsh gets the job, his hands are mostly tied. He can't just flip the script on day one. Analysts are now suggesting that if you look at the reality of the U.S. economy, Warsh might not be nearly as hawkish as people fear. The dollar spike and the gold dip we saw are likely just a short-term overreaction to the news. From a historical lens, this isn't a repeat of the 1980s or 2013. Let's look at the two biggest gold pullbacks in history. January 1980 down 13% and February 1983 down 12%. The world back then was completely different. In the 80 seconds, Paul Volcker pushed interest rates above 20% to kill hyperinflation. That aggressive move made holding cash better than holding gold. At the same time, the dollar rose 77% because of those high rates, which crushed gold. Looking forward, we expect the dollar to enter a long-term weak phase rather than a sustained rally. Why? The U.S. current account deficit is the smoking gun. It has been over 4% of GDP for 6 straight quarters. History shows that whenever this happens, the dollar is oversupplied and has an 80% chance of losing value. Plus, the massive U.S. fiscal deficit and the global de-dollarization trend will keep the pressure on the greenback. A weaker dollar is one of the primary engines for a gold rally. This is also nothing like the taper tantrum of 2013. Back then, after 5 years of easy money, the Fed suddenly said they were going to stop buying assets. That shocked the market, and gold dropped over 28% that year. Today, the market has already priced in the Fed's moves. The FedWatch tool shows the market only expects about 75 basis points in cuts over the next year. This is a drop in the bucket compared to the massive shifts we saw in 2013, since expectations are already so low. This gold rally isn't built on a surprise from the Fed. It's built on long-term structural issues. There isn't much room for gold to keep falling. Another huge pillar for gold is the behavior of big institutions and central banks. Sovereign wealth funds, pensions, and hedge funds have all said they plan to diversify over the next few years. Their goal? Reduce their reliance on the US dollar and buy more hard assets like gold and commodities. Our data shows that as of January 2026, these big players are still moving in that direction. We haven't seen them blink yet. Statistics show that sovereign funds bought over 500 tons of gold in 2025, a record high. And central banks aren't slowing down either. Both their words and their actions prove they want to keep stacking gold. This isn't just about diversifying anymore. It's a strategic move to protect their own currencies against a volatile US dollar. There's really no limit to how much gold they might want to hold. Right now, gold makes up about 28% of global central bank reserves. That's up from 10% in 2010. Emerging markets are buying way faster than developed ones. Even with last Friday's crash, gold is still up 9% on the year, beating most other assets. Silver has done even better, up 15% since January. Experts believe that as growth slows and central banks keep things easy, Geopolitical risks will keep the wind in gold's sails. This short-term dip is actually a rare gift for long-term investors to get in. Let's wrap this up. We are in a fierce tug-of-war between short-term noise and long-term facts. In the short term, Fed suspense, exchange rule changes, and a dollar bounce will act like a hammer on gold prices. The volatility isn't over, and the shakeout might continue for a while. If you can't handle the heat, this is going to be a tough stretch. However, we must see one thing clearly. Short-term reasoning will eventually make way FPR long-term trends. For investors, the current market may be in a complex but opportunistic window. Until the new deal is set in stone and the macro picture clears up, expect the market to stay choppy and volatile. As investors, we need to develop a bit of X-ray vision to see through the noise. We have to look past the daily price swings and stay focused on what gold actually represents. It's not just another ticker symbol. It's the ultimate anchor for credit and a reflection of the global monetary system. As long as the US dollar's credibility is showing cracks and the global debt bubble keeps expanding, the massive repricing of gold is far from finished. Finally, I've got a question for all of you watching. After the absolute roller coaster we've seen over the last few days, what's your take? Is gold finally hitting a ceiling, or is it just fueling up for the next leg higher? Do you think $6,000 is still on the table for this year? Drop your thoughts in the comments and let us know your game plan. Are you looking to exit in the heat of the moment, holding through the storm, or buying the dip to grow your position? Just a reminder, as the saying goes, this analysis is purely my own perspective and logical breakdown here at Gold Off the Charts. It isn't specific financial advice. Trading is a journey that requires constant practice. Market risks can come out of nowhere, so please think for yourself and make moves that fit your own risk tolerance. If this video helped you clear your head and cut through the daily market noise, then please show some love by hitting the like button and subscribing. Share this with any friends who are feeling lost in the current market. This is Gold Off the Charts. See you in the next one. Later.